Please welcome Jamie Rush, Chief European Economist, Bloomberg Economics.
Well, hello everybody. I hope you've been having fun over the past couple of days. I know I have. Now, I thought I'd start by taking you back to the beginning of my career, a bit before the global financial crisis at the UK Treasury. And back then, the job of an economic forecaster seemed pretty simple. We looked at these wiggly lines and we tried to predict where they would go, and it helped an enormous amount that they didn't wiggle too far from baseline. All you needed really was a PhD in economics, and you do a passable job doing an economic forecast. Things have clearly changed quite a lot in the subsequent years. Being an economist is not enough. You need to be an armchair virologist. You need to be a political scientist, a climatologist, and there are even some of us masquerading as military strategists. The point is that the interdisciplinary wisdom is required to be able to even have a hope of getting things right. Why has the world become such a more complicated place to forecast? Well, I think some of you would agree with me that it has something to do with the political ideologies and the splits we are seeing across the globe. We cannot coordinate ourselves at the global level in a way which delivers stability. Clearly, strategic rivalries didn't cause the pandemic, but they do have a role to explain why China's economy opened a year later than everyone else's, think of vaccine nationalism, and also why the supply chain crunch was as bad as it was. So what we're seeing is that crises are coming together, they are amplifying one another, and really with quite staggering results. So what this first chart shows, it's always the most humbling chart to show, is some of the consequences of the crisis that we've seen. The blue line shows our forecast for inflation as of mid-2021, peaking around about 3 to 4%. We were wrong by a massive order. In fact, we saw inflation of closer to 10% at the global level. Clearly, big implications for the economy. It caused a huge squeeze on household spending power, and central banks' response to the inflation crisis has obviously squeezed the economy further. So we're now forecasting that the economy will be about 3.5% smaller than it otherwise would have been by the end of 2024. So essentially, we've lost a year's growth. Now, I just want to focus on a couple of questions for the short term and a couple of bigger questions about the longer term outlook. So the first question is about where inflation is likely to settle. Now, we all know that headline inflation is coming down relatively swiftly. But the real question is it going to land at 2% or 3%, or is it going to land at 4%? And when we look at the tightness of the US labour market, it's hard to see it coming down below 4%. Why is that the case? Well, what this chart shows is labour costs, which is wages adjusted for productivity. It's what matters for businesses when they set prices. And those are rising at the fastest pace that we have seen since the early 1980s. So, very big change. What we're not going to see then is that core inflation settles until we see a change in the labour market in the US. And that isn't, at least it's not evolving right now. In Europe, what we've seen is not so much on the wages side, but we have seen that businesses have taken advantage of the inflationary environment to fatten their profit margins. And so what this chart shows is the contribution to inflation of the prices of stuff that we produce here in the Eurozone over the past 2 years. The blue bars are profits, the orange bars are wages. Normally, profits don't contribute very much to inflation at all. These blue bars should be very small. Instead, they account for almost 5.5 percentage points of the increase in the price level of stuff that we produce here in the Eurozone over the past 2 years. So until we see a change in the pricing strategy of companies, again, it is hard to imagine that inflation on an underlying basis is going to come down. And that's what we see for the UK, for the Eurozone, and for the US. Our forecasts show core inflation staying in the 3 to 4% range all the way out to mid-2024. And that means a couple of things. It means that interest rates are likely to go up further from where they are now. It also means that interest rates will stay high across this year unless we see something dramatic happen. So what's the probability of that? We're looking very carefully at how interest rates are affecting the economy. We know they are feeding through to borrowing costs for people people's mortgages, for businesses. And we're seeing it start to show up in the supply of credit in the US economy. This chart shows that small banks are now reducing credit at quite a fast pace. Large banks are now getting on the action too. For the Eurozone, we see that credit conditions are tightening very fast. So this is the Bank Lending Survey. It's something that Philip Lane, the ECB's chief economist, mentioned just at this very event on Tuesday, saying that it's going to be pivotal to the ECB's policy decisions over the coming months. What we see is that credit conditions are tightening, similar to what we saw during the sovereign debt crisis. And I can draw a similar picture for the United Kingdom. Again, we're seeing credit conditions tighten, and at the fastest pace since the global financial crisis. So we are seeing that monetary policy is transmitting, and it is going to have an effect on the economy. The question is, are we going to see a recession as a result? Now, when we plug some of these changes into models that we use to forecast the probability of recession, this is for the US, we get some very high numbers. In fact, our models tell us that there's a 100% chance of a US recession at some point this year. Can we believe those models? And I think we need to think about two things, two elements of this. The first is that these models are trained on history. And over history, the banking sector was not as well capitalized as it is now, and people didn't have as much buffers in terms of their savings as they currently do. So maybe there's reason to believe that the implications won't be quite as severe as they have been in the past. On the other hand, the shift in expectations for interest rates is without precedent. If you think about the Eurozone, people expected interest rates, or people in markets expected rate, to stay at zero for pretty much forever. Now, long-term interest rate expectations are closer to 3%. So there's a balance here. Our view is that the US will enter a modest recession at the end of this year, and that the Eurozone and the UK will basically stagnate for the rest of this year. A couple of questions for the future. We've talked just very briefly then about the short-term impact of higher interest rates. The long-term impact is going to be absolutely colossal. What marks this cycle out from other ones is that it's not just that people now expect interest rates to be higher now, it's that they expect interest rates to be higher permanently. And this has huge implications for governments and the fiscal position. I've picked on Italy here. It shows our debt to GDP forecast based on interest rates that prevailed in early 2022. If we change nothing else about our assumptions, but just put in the new interest rate path assumed by markets, the picture is vastly worse. And I've picked on Italy, but you can actually apply the same logic to quite a few countries. The US, the UK, France, Italy, Japan, they're all going to see debt servicing costs as a share of GDP rise very substantially as debt rolls over onto these higher interest rates. Germany, of course, there's no problem, as ever. So what we're expecting is that if 2022 was about inflation, 2023 is about interest rates, 2024 could well be about fiscal positions and the recognition that there is a lot of hard work still to be done. The other question I just wanted to put some context for you around and put some numbers on is the topic of we've been discussing over the past couple of days, deglobalization. We heard on Stephanie Flanders' panel early yesterday morning about the regionalization that's occurring in our economy, and I've divided it into authoritarian states and democracies. And we can see that by 2030, authoritarian states will account for about a third of global GDP, so substantially more than was the case in the early 2000s, for example. And trade ties have clearly intensified substantially. What we've done, using a global model, is imagine that the world splits along those axes, and tariffs are imposed between the two blocks. And the result of that shows that we would see trade fall by about 20%, taking us back to the early 1980s. And this would have an impact on GDP because it harms productivity. It could take about 3.5% off the level of GDP. The IMF, who've imagined an even more fragmented world, think that the impact could be as high as 7% of GDP. And that's before you put anything in like geopolitical conflict, actual conflict. So I will actually leave it there. I've realised that I haven't filled the room with joy and glee. But I'm an economist, you should expect nothing less. If you'd like more gloom, please go to Beco Go on the Bloomberg terminal. If you do want your spirits lifted, take a walk outside. The sun is shining, and I'm sure it'll do the world of good. So thank you very much. I'll leave you with that, and enjoy the rest of your time.